Do you agree with Carson Block? It was a pretty negative message that he put out on our air just yesterday.
Good morning. Great to be with you. I think the book is being judged almost entirely by the office sector. The perceptions and the reality of office being hit very hard, like shopping centers were 10, 15 years ago because of e-commerce, is really rippling throughout the entire industry. So you have apartments, self-storage, hospitality, mobile home parks, medical office that are performing very differently. And you have retail, including the bread and butter, brick and mortar neighborhood and community centers that are making a huge comeback because of the fact that they've had 10 years to basically reposition, remove a lot of stock, and reinvent themselves. And therefore, commercial real estate as a whole is performing much better than expected. Delinquencies are less than half of what they were in the Great Recession. Occupancies across the board, except for office, are holding up incredibly well. And even within office, newer product has vacancy rates that are around 11%. 10 years or older product, especially in urban markets, has a 25% vacancy rate. So the variations of commercial real estate is where the money's made, and the generalizations is where money's lost.
Okay, so let's take generalizations off the table and go specific. What's leading and what's lagging in that portfolio of commercial real estate that you just laid out?
The number one asset class right now remains industrial warehousing because there's been so much consumer strength and e-commerce demand creating the need for warehouse distribution space that is modern and has just-in-time inventory capabilities and proximity. The last mile issue with e-commerce is still a huge problem, but industrial continues to do very well. Multifamily apartment rentals are doing very well because houses have become so much more difficult to afford for consumers. They're staying as renters longer. The renewal rates on apartment leases are at a multi-year high, and those rents are growing in the high single-digit year-over-year levels because people are staying put and they like where they're already living. So occupancies on apartments is doing very well. And retail is the comeback kid. It was the dark horse. Everybody wrote it off, and there was 10 years of pain in retail. I've just come from a tour throughout California, Texas, Florida, and here in New York in the last 3 or 4 days for a retail shopping center convention. All the major owners are here, are the major tenants are here for ICSC is the trade group for retail. The optimism for retail and pricing power that owners have today on retail is unique in 20 years. Nobody's talking about these things unless you're in the industry.
So let's talk about that supply-demand dynamic in the shift, because ultimately where it plays out is in price and valuation.
Right.
Interest rates have upset a lot of models over the course of the last 2 to 3 years. What exactly does the valuation picture look like right now? Are there values to be had? Can deals get done in commercial real estate?
Great point. Sales transactions are down 50, 60% this year for the very reason you mentioned. Interest rates have shocked the valuation part of the equation. Lenders have pulled back from lending because of all this concern, and legitimately so over the last year. But prices are adjusting. It takes time for sellers to come to terms when they have to sell a property that your current price is not what it was a year and a half ago. Interest rate increases directly translate to price reductions, and that's happening gradually. We're seeing somewhere around the 15 to 20% price reduction from peak across the board, and that is creating transaction velocity now. The sideline capital waiting to come back in is at a record level.